Exxon Mobil, the largest oil company in the U.S., is boosting the compensation of its CEO and other top executives for next year. Chief Executive Darren Woods will earn a base salary of $1.88 million in 2023, a raise of more than $100,000 from the year before, according to a filing. And Catherine Michaels, who became the company's chief financial officer 16 months ago, will receive $1.22 million in pay for 2023. But these are just base salaries, which represent less than 10% of total pay. Stock awards and bonuses make up the lion's share of what Exxon's top brass pocket every year. CEO Woods, for example, was awarded a total compensation of $23.6 million in 2021. The pay hikes come barely a month after Exxon posted record quarterly profits as sanctions on Russia sent crude and gas prices soaring to dizzying heights. The oil industry's windfall profits this year has attracted the attention of U.S. President Joe Biden, who has accused the sector of war profiteering and said Exxon was making, quote, more money than God. Biden has repeatedly called on U.S. oil and gas companies to use their record profits to increase production and reduce pump prices for Americans.
Tankers loading at Russia.
U.S. stocks ended lower on Monday as investors were spooked by better-than-expected data from the services sector and reevaluated whether the Federal Reserve could hike interest rates for longer than expected. The Dow fell 1.4%, the S&P lost nearly 1.8%, and the Nasdaq dropped more than 1.9%. Data showed activity in the U.S. services industry unexpectedly picked up in November, with employment rebounding, offering more evidence of underlying momentum in the economy, not what the Fed wants when it's trying to slow the economy in order to cool inflation. Anna Rathbun is Chief Investment Officer at CBIZ Investment Advisory Services.
Those data include better than expected factory orders, durable goods, and in particular, the ISM Service Index came in very strong. And in the service index, we had details like sticky prices on the prices paid side and very strong employment sub-index, the two very things that go against the Fed pivot narrative. And this is really interesting because the Fed, well, the Chairman Powell was very hawkish last week, and the markets actually didn't interpret it that way. They were cherry picking the 50 basis point signal, and markets went up. Well, today it's a little bit more sober.
As for individual movers, Tesla slumped 6.4% on plans to cut December output of the Model Y at its Shanghai plant by more than 20% from the previous month. And apparel maker VF Corp dropped 11.2%, its largest one-day decline since March 2020, after announcing the sudden retirement of its CEO. The firm, which owns names including outdoor wear brand The North Face and sneaker maker Vans, also cut its full-year sales and profit forecasts, blaming weaker-than-anticipated consumer demand.
Tesla has denied reports it will slash output in Shanghai. Reuters sources had said production of the Model Y SUV there would fall by a fifth. Now the car firm has called that untrue. Inventory levels at the Shanghai facility have soared after a plant upgrade over the summer. The US automaker has also been taking steps to shift stock. It reduced prices in China by up to 9% and offered insurance incentives. Unusual moves for Tesla. The steps helped boost November sales of its China-made cars by 40% on the month. High inventory levels in Shanghai come as the country's car market faces slowing demand and disruption to supply chains. Uncertainty over when China will lift its strict lockdowns has clouded the outlook for the sector. Though Monday saw reports that Beijing is now ready to embark on reopening measures. Globally, Tesla had planned to push production of its Model 3 and Model Y vehicles sharply higher in the fourth quarter. That as new factories in Texas and Germany ramp up. It's working on a revamp of the Model 3 to boost demand for the 5-year-old sedan.
South Korean trucker Kim Young-chan is making sure his vehicle still runs okay after sitting idle for more than a week. He's one of about 25,000 truck drivers on strike in the country over minimum pay rules. Faced with soaring fuel costs, they say minimum pay protections are all that stand between them and poverty. But the current government has called them well-paid, quote, labour aristocracy.
Labor aristocracy? That is nonsense. Are we getting well paid? Our money is stretched so we can eat and live for a month. How can we be a labor aristocracy?
During the strike action, the truck drivers have been living in makeshift tents. This is the second time they have been on strike in less than 6 months. And the action has disrupted South Korea's supply chain. The government and the union have sat down for talks twice, but remain far apart on 2 key issues: extending the minimum pay rules beyond the end of this year and expanding them to benefit more truckers. Now, South Korea's President Yoon Suk-yeol is preparing to widen a back-to-work order. Yoon has accused the truckers of holding the nation's economy hostage. The industry ministry said on Thursday that the strike action had cost $1.2 billion in lost shipments over the first 7 days. But truckers like Kim remain defiant and have vowed to fight on.